What's going on, people? It's your boy Kalechi back with another video. If this is your first time around these parts, hit that subscribe button. If you enjoy anything we talk about on this video, hit that like button. Today we're going to be taking a look at Berkshire Hathaway's annual shareholders, aka Warren Buffett's annual shareholders. It's one of those things that, as somebody who is trying to be a better investor, as somebody who's trying to learn more about investing, as somebody who just wants to learn from the legend, it's one of those things where you're able to get some insight into the way he thinks about investing, into the way he does his investments. And so I just decided, while I went through this, I read through the entire letter. It's about 14 pages. One of those pages just shows his returns versus the S&P 500, which he has had a return of 2.8 million% versus the S&P 500, which has had 23,000% over from 1964 to 2020. That's crazy, man. That's really, really crazy to have that kind of return. But then again, that's why he is the legend known as Warren Buffett. But anyway, I went through this letter. There's a lot of good insights in this letter, and I just thought that we can go through this together, and I'll just point out a few things that I noticed in the letter. So the first thing that I noticed in the letter was Warren Buffett admits his mistake. Even as a great investor, one of the things he did, it was just like, yo, I made a mistake with one of the investments that I made. So he talked about, I'm just going to read it word for word from the document. It says, the final component in our GAAP figure, that ugly $11 billion write-down, is almost entirely the qualification of a mistake I made in 2016. That year, Berkshire purchased Precision Cast Parts, which is an aerospace company, if I'm thinking about it right. And I paid too much for that company. No one misled me in any way. I was simply too optimistic about PCC's normalized profit potential. Last year, my miscalculation was laid bare by adverse developments throughout the aerospace industry. COVID-19 is not nice to anybody. PCC's most important source of customers. In purchasing PCC, Berkshire bought a fine company at the best in its business. Mark Dunnigan, PCC CEO, is a passionate manager who consistently pours the same energy into the business that he did before we purchased it. We are lucky to have him running things. I believe I was right in concluding that PCC would, over time, earn good returns on the net tangible assets deployed in its operation. I was wrong, however, in judging the average amount of future earnings, and consequently wrong in my calculation of their proper price to pay for the business. PCC is far from my first error of that sort, but it's a big one. This is something that's huge that I'm learning. The price you pay for a business matters. The price you pay for a business matters. Even Warren Buffett is saying it here, like, yo, this business is actually a great business, but at the end of the day, it doesn't matter if you're buying the best of businesses if you buy it for a bad price. Again, it goes back to that word, margin of safety. As much as it pains me to actually have to agree with this, it's actually making me rethink my investing strategies. Because one of the things that I'm having to learn to do is, maybe it's better to just sit with cash rather than jumping into the market and buying an overpriced business. You guys have heard me talk about Lemonade a bunch. You guys have heard me talk about Airbnb a bunch. You guys have heard me talk about a lot of different businesses. But one thing that has been holding me back from investing in any of these businesses is right now valuations kind of seem like they're flying out of the door. Nobody is thinking about valuations anymore. And so it's really hard to get into any of these businesses. And as a matter of fact, I was going to jump into the market, but something I've been hearing consistently and having to think about consistently is valuation does matter. And so after reading this, I was like, you know what? Even though cash may be devalued, it might be better for me to actually just sit and hold on to this cash for a little bit longer until the market kind of comes back to a reasonable point. So, and then the other part of this is, you're going to make mistakes. This is another important thing that you have to think about when it comes to investing. For anybody who's scared about investing, you're going to make mistakes. There's no two ways around it. Even Warren Buffett, a guy who we just said that had over 2.8 million% in returns, he still makes mistakes. And so the thing you have to accept is making mistakes is not necessarily a bad thing. Sometimes it is good to take that risk. And it's just learning how to balance your risk to your reward. So the next part of this thing that I thought was pretty interesting for him to say was, he said, bonds are not the place to be in these days. Can you believe that the income recently available from a 10-year treasury bond The yield was 0.93% at year end. Of course, that has come up to 1.5 something right now. That has fallen 94% from 15.8% available in 1981. It's crazy. Bonds, this is the thing I've been saying over and over again. I'm not in any bonds. I don't want bonds right now. Bonds do not give me any kind of good returns. And so right now I don't have any bonds and I don't plan to own any bonds. But like I always say, I change my mind as the information at present changes. So as bond becomes more better, I may buy some bonds. But it's just interesting the way he had a look on it. And then after that, he just talks about the cash position of Berkshire. He says Berkshire now enjoys 138 billion of insurance float. Now, insurance float is basically the money doesn't, like he says on here, funds that do not belong to us, but are nevertheless ours to deploy, whether in bonds, stocks, or cash equivalents such as U.S. Treasury bills. Float has some similarities to bank deposits, cash flow in and out daily to insurers, with the total they hold changing very little. Basically, all that is whenever you pay your insurance company, your premiums that you pay every single month, you know, your bills, you're paying that every single month. You're not going to need that money all the time, right? You only have incidents once in a while. And so a lot of your money gets reinvested. That's how insurance companies make profit. It's not just by collecting your money, but reinvesting your money into other things. So when you pay State Farm takes that money and goes to reinvest it into something else. It's something that I'm learning a bit more of because I'm interested in Lemonade a lot. And I really want to get into Lemonade. I really want to buy shares of Lemonade, but I'm still understanding how insurance works. Now, Lemonade is a little bit different because it's a reinsurer. So it's a little bit different, their strategy there to be able to bring costs down. But either way, it's just interesting. And I believe Berkshire is also a reinsurer. So basically, they don't have to take a lot of the problems that insurers like Progressive or Nationwide or State Farm have to take on, but they're still able to give you those nice, they're still able to cover people, which is pretty cool. And the thing about this that's important for me is the fact that they are still sitting on $138 billion and they haven't done anything in the market. I think one of the things he says the massive sum held by Berkshire is likely to remain near its present level for many years and on a cumulative basis has been countless to us. The happy result, of course, could change, but over time, I like our odds. So it's kind of teaching me that, you know what, it's okay to sit on cash. You don't have to rush out and always be doing something in the market. And it's teaching me, be patient. Part of being an investor is being patient, taking your time with your investment strategies. The next part of the paper that I think is very interesting to read about is the fact that Berkshire is buying back its own stock, but it's important the way that they are buying back their own stock. He says that in no way do we think that Berkshire shares should be repurchased at simply any price. I emphasize that point because American CEOs have an embarrassing record of devoting more company funds to repurchases when prices have risen than when they have tanked. Our approach is exactly the reverse. And that's something that I'm not a fan of share buybacks. I'm really not the biggest fan of share buybacks. I think you can do so much more with the money when it comes to like maybe research and development so that you can hire more talent, so you can pay your employees more money rather than buying back shares just to give value to shareholders. I'm not the biggest fan of share buybacks. However, if you are going to do share buybacks, please do it at a good price. Don't just do, oh, we're just going to spend $2 billion on share buybacks. Whatever the price is whatever the price is. Like, no, that's not how you do share buybacks. Just like how investors, we have to figure out what's the best point of entry for a stock, and then we buy back those shares. It's not just you buy it at any point in time, but a lot of the time, whenever a company announces share buybacks, it doesn't matter at what point that they're buying the shares back. They're just buying the shares back because that's how they plan to spend their money. That's their own version of research and development to give shareholders equity in the company. I'm not a biggest fan of share buybacks, but Berkshire did it because that was the best way that they could use their money at the time. And then the next part of this, he had a lot of write-up. Basically, he just went on this soliloquy in the paper of telling stories about different companies that started out small, that Berkshire have taken over, and how it was a small company. And basically, the whole point of the whole thing that he talked about was, at the very end, is like, our unwavering conclusion is never bet against America. You know, basically, he's just saying America is number one. He was just praising the fact that America is like a great incubator of talent, incubator of resources, incubator of all of that stuff, which I don't necessarily disagree, but there's a lot of other things that in America that we need to fix and work on, which of course he didn't speak to any of it. The other thing that was interesting was when he went through this story of talking about America and talking about the different people in America and talking about the different companies that they've acquired. One thing that was a consistent theme in every single one of this story was he will just meet with the owner, meet with the founder, have a 15-minute conversation with the guy, and then be like, yeah, I believe in your business. And he would acquire the business or acquire a nice stake in the business. One of the stories he told is about a guy named Jack who opened an insurance company in Omaha, and then he's grown that insurance company to be a large one. He says, fortunately, I was nearby on one of those occasions. Jack liked the idea of joining Berkshire, and we made a deal in 1967, taking all of 15 minutes to reach a handshake. I never asked for an audit. Today, National Indemnity is the only company in the world prepared to insure certain giant risks. And yes, it remains based in Omaha. And then again, it talks about another company, a furniture company that's still doing really well in Omaha, Nebraska right now. It's called, what is it called? NFM, which is Nebraska Furniture Mart. And basically, he talks about a lady named Mrs. B, who is still alive at 103 years old. And basically, they still run the furniture store, and it's still one of the largest home furniture stores in the entire US, and actually sets sales record every single year, even in 2020. But of course, in 2020, everybody was buying new furniture for their home. So that was something to be expected there. But the point is, having great leadership for businesses is so important. Having a great founder, having a great CEO, having great leadership. That's why I talk about it all the time. Management is key when it comes to investing. Knowing that the managers are going to do something. Now, of course, we small investors are not going to get access to Fortune 500 CEOs or most large company CEOs. But one thing that I'm starting to do is I'm thinking about reaching out to some CEOs, using my platform, my podcast, to reach out to CEOs and just be like, hey, would you mind coming on the podcast so I can talk to you? I know Daniel Schreiber, who's the CEO of Lemonade, has done it multiple times with relatively small channels where he just goes on there and talks about the company. That's something that I would like to do because there are questions that I would like to ask the CEOs about how they're operating their business so I can understand them better. But the second best thing is just literally watching every single interview about the person that you're about to invest money into the company and seeing how they think, how they plan for that company to go, how they plan to adjust themselves to different circumstances. Because at the end of the day, the CEO or whoever is at the top is the one that's given the vision to that company, right? Is the one that's granting the vision of how that company is going to grow over time. So very important. And then the next section of the letter, I mean, he keeps on talking about his partnerships within Berkshire, and he talks about the different divisions of how people invest into Berkshire. He talks about the 4 categories of investors. You have him being the founder, then you have different institutional investors, you have single investors like you and I who may buy stock in the company, and then you have a bunch of other people. The one thing that I found very interesting is that he has a lot of friends that are over 90 years old, which is something that for me is shocking. And then it just brings a revelation to my eye of like, yo, why are we in such a rush to do everything so quickly? Why are we in such a rush? I mean, one of the things I've been dealing with is like, I always feel like I missed something, like I missed out on an opportunity. I always feel like I'm behind in life. But in all honesty, like a lot of these guys, you see their ages like they were 90, 100, 97, 95. Like a lot of these people are really old and they never acquired wealth until they were well into like their 50s, their 60s. Like it's crazy when I was reading through all of this, and then it just made me realize something. It's like we need to slow down, man. It's something that Gary Vee talks about all the time. He's like, yo, you have a long time to live. By the grace of God, all of us will live a long life, and we'll be able to see our grandchildren and our great-grandchildren until the 3rd generation or something like that. But we have a long life to live. With the betterment of health and technology and medicine and everything, we're more than likely going to live a long life. So why are we in such a rush? Why am I in such a rush all the time? Why do I always feel like, oh my God, I'm behind. It's like, it's okay. Enjoy the journey. enjoy the journey. There's a lot to love about life, you know? And that's just interesting. One of the jokes he says in here, he says, two of Stan's comrades from MD are now in their high 90s and continue to hold Berkshire shares. This group's startling durability, along with the fact that Charlie and I are 90, 97 and 90 respectively, serves up an interesting question. Could it be that Berkshire ownership fosters longevity? Which is a just interesting joke. But I just like the fact that he pointed that out. It's like, man, we are all in such a rush. Like, everything has to be microsecond. But he's like, yo, it's okay. And then to go along with that fact, he talks about really to build wealth, it takes time. It takes a long time. And then, of course, he throws shade at day traders and any kind of traders in general. He said, in one part, he says, the tens of millions of other investors and speculators in the United States and elsewhere have a wide variety of equity choices to fit their taste. They will find CEOs and market gurus with enticing ideas. Does that sound interesting to anybody, especially out here in this YouTube realm? If they want price targets, managed earnings, and stories, they will not lack suitors. Yes, we live in an age. I think I even did an entire video talking about everything is about a story right now. Or maybe I was talking on my podcast where if you have a good story for a stock, you're probably going to do well. Technicians will confidently instruct them as to what some wiggles on a chart portend for a stock's next move. The calls for action will never stop. Many of those investors, I should add, will do quite well. After all, ownership of stock is very much a positive sum game. Indeed, a patient and level-headed monkey who constructs a portfolio by throwing 50 darts at a board listing all of the S&P 500 will over time enjoy dividends and capital gains, just as long as it never gets tempted to make changes in its original selection. Productive assets such as farms, real estate, and yes, business ownership produce wealth. Lots of it. Most owners of such properties will be rewarded. All that's required is the passage of time, an inner calm, ample diversification, and a minimization of transaction and fees. Still, investors must never forget that their expenses are Wall Street's income. And unlike my monkey, Wall Streeters do not work for peanuts. When seats open up at Berkshire, and we hope they are few, we want them to be occupied by newcomers who understand and desire what we offer. After decades of management, Charlie and I remain unable to promise results. We can do, however, pledge to treat you as partners, and so too will our successors. Basically, he's just talking about long term. Don't just think about the short-term game right now. I mean, we saw a slight dip in the market and I was seeing all kinds of panic. I mean, I was reading about ARK Fund and the fact that over $450 million flowed out of that fund in one day, because there was slight panic in the market. And so it just shows like people are chasing after the next quick fix, but really it should be long-term. It's just like when you're dating somebody and you want to get married, it's not about the hit it and quit it. That's not impressive. The impressive thing is when you see somebody that's been married to one woman for 20 years, 30 years, 40 years, 50 years, and it's that consistency, and you can just see how they've grown together. It's the same way with investing. The long game is what you really want. You don't want a short-term fix, because even if you go up, like I was talking to my guy Tolu, it doesn't matter if you go up 150%. If you lose 90% of that, that still sucks, right? It still sucks because you're not compounding over time. You're actually losing. If you go up 100% and lose 90%, what's the point, right? What's the point? So it's just interesting. It's like always play the long game. In the long term, you will always win. If you play for the long term, if you're not focused on like, oh my God, what's the one that I need to jump into today? What's the one I need to get out of? If you just focus on the long term, you will be fine. And I think, yeah, and the other thing he talked about was one of the businesses, which is BHE. I know a lot about this business mainly because I work in the transmission industry. So if you're a kid out there and you're looking at engineering, look for transmission line design jobs. Look for transmission engineering opportunities, whether it's substations and all that kind of things, because as we move away from having coal plants and move into renewables, a lot of work needs to be done in all that infrastructure. So just something to throw out there for anybody who is thinking about that. I know a lot about these industries, and most of the money is going to be spent in building transmission lines, because now it has to be from way further out. In the past, coal plants could be relatively close to where they're serving the power, but now most of your power is going to be coming from renewable sources like wind, solar farms, and those kind of things that are way away from the cities where they'll be serving. which has some issues in and of itself as well, but that's besides anything else. And then the last thing that he talked about in the shareholders letter was the next date for the annual shareholders meeting, which is something that I believe if you're an investor, you gotta watch it. It's always intriguing. It's always interesting. It's a 4-hour thing where literally Charlie Munger and Warren Buffett sit and answer every single question that is posed to them for 4 hours. Sometimes it gets boring because if you don't understand finance that well, the first time I watched it was last year because really I was at home and I wasn't doing anything. But it was still interesting though. It was still interesting to listen to as somebody who was trying to get into it. There was a lot of stuff that flew over my head. I'm not going to lie. And it's not like I watched the whole thing. There were interesting parts and bits and pieces to it. And of course, I found segments on Yahoo's page. So if you want Warren Buffett to answer any of your questions, you can literally send an email to berkshirequestions@cnbc.com and he will answer any question that you wanted to answer. But anyway, that's all I got for y'all. I hope y'all got something out of this entire thing. I'm weird because it's 10:30 and I decided this was when I was going to read this. But anyway, I hope y'all got one, maybe two things out of this entire thing. Is being your boy Kelechi. Remember, generosity is always greater than greed. God bless each and every single one of y'all. And I'm out. Peace. Whoosh.